Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for 𝗧𝗶𝗱𝗲𝗀. Today is Tuesday. It's the 22nd of June. I'm reading this. I'm saying 22nd of June, and I'm shaking my head and thinking, where in the world did this year go? I'm still thinking like March, April of COVID last year. I just don't know. Well, the markets are going to open up in less than 2 hours, about an hour and 50 minutes or so. And this is what I do every morning, with or without you guys. I go through this analysis. It helps me keep my head straight. Markets are fairly random outside of the Nasdaq 100, which is actually pretty bullish. I do expect to see the blue chips start gaining strength, and I wouldn't be surprised if I saw the Nasdaq 100 cool off a little bit, but we're not seeing it just yet. But the night is still young. And we're not up all that much, but it is a little bit too much, and I think the techs are going to start seeing a little bit of a cool-off. The large cap tech. Why? Because sensitivity to interest rates. Interest rates are going higher. Bonds are going lower. Interest rates and bonds are inverse, and that's bad or negative for techs. But we still have a little bit of a move left, and I think the market is a little broad right now as opposed to as narrow as it was a few weeks back. So we're still seeing upside, and I'm going to go with it. I'm also liking the fact that the S&P 500 is becoming bullish once again. And if you look at the momentum levels, this is why I think the overall market will be bullish, because a lot of the same stocks in the S&P 500 are in the Nasdaq 100. So if the S&P is going to come up with a bounce, that means the Nasdaq will as well, at least for the next few sessions. Also, momentum levels, and this is something I watch really, really carefully. Looks like they bottomed out yesterday, so it looks like we're going to go higher, at least for the time being, and then maybe bounce back down. But if you look over a few years, momentum levels, and I was warning this was going to happen. I told you it was going to happen. It was just a matter of time. So it looks like momentum levels on the short term are relieved a little bit. But with that said, don't hold your breath, because on a long-term basis, oh man, look at this thing. We're just getting started. So there's a lot more potential downside. But again, this is the 200-day moving average, and we could see this stick around for another month or so and not really do much. In terms of news, we've got existing home sales today, and we got the manufacturing index. I don't think either of the report is going to be too instrumental unless it's completely off, and it doesn't seem that way, especially with existing home sales. June tends to be a really strong period because a lot of people want to lock in their addresses before junior starts school in August and September, so they have a permanent address, because schools usually need that information long before people or kids enroll. The big report, as I mentioned, is going to be the GDP report this Thursday, and the durable goods and the international trades. Thursday is going to be the big day for news, and Friday, but I think Thursday is going to be the real big one. You got to watch the bond market, and I think we're going to go back down to the base, which means higher inflationary pressure in the near term. As far as global economy is concerned, let me just get down to the nitty-gritty here. Federal Reserve Powell said economy is growing at a healthy clip, and that accelerated inflation. Really? He's admitting it. Wow. In written testimony to be delivered at congressional oversight hearing today, Powell reiterated his view that inflation recently jumped to a 13-year high. But he's holding on to the whole temporary angle. I hope he's right. Despite reassurances from Powell, renewed COVID outbreaks are clouding the outlooks in much of Asia, especially India, where it's really bad. Investors are still trying to figure out the ramifications of the Fed's forecast that may start raising short-term rates by late 2023. That's earlier than previously thought. Yeah, by a little bit. The Fed also began talking about slowing programs meant to keep longer-term rates low in acknowledgement of the strengthening economy and the threat of inflation. And yes, inflation has been rampant, and I mean rampant. So, markets are fairly random. Bond market is cooling off, as we expected. If you look at the stock fetcher code, you will see that right now, if we look at the main sectors, which we're going to look at right now, you will see that financials are looking like they're bouncing. Energy is looking like it's bouncing. Industrials looking like it's bouncing. Consumer staples looking like it's bouncing. And tech, look at tech. It's all the way near its support level, which means it could break out nicely right here. Even basic materials and utilities are bouncing. So I'm thinking the market's going to be fairly bullish. I'm not really seeing anything too negative right now. Some of these pullbacks are a little bit too much, but if you consider the fact that momentum levels were overbought for a real long time, the fact that the number of stocks in the here, let me just go back here, in the 50-day line, like really went down from 80th to 40th percentile over a period of, let's see here, April, June, less than 2 months. That is a significant relief, and that's going to tell me that we're moving higher. Now, if we go and look at these sectors on a mathematical basis instead of visually, you will see that energy, real estate, technology now, and communications are coming back up. If you look at it on a 1 month basis, you'll see that technology is now leading. I think that's going to cool off, and I think you're going to be stuck with the real estate, the healthcare, the energy, industrial, the basic materials. I think they're going to lead again. But right now, technology, communication services are real hot. So we want to take advantage of that. So we've got 𝗧𝗶𝗀 Instruments. What does it do? Industry, machinery, manufacturing, Russell 2000. It has a lot to do with hard drives, wireless chips. So is it really a manufacturing company or is it really a tech company? Somewhere in between, but it's small stocks. And I think small stocks are going to be coming up because they have been very, very choppy. Let me just show you something here. Let me just go to a template here. See, they're right at the 50-day line, and I think they're going to be coming back up and making new highs. So I like smaller stocks right now, and I like this 𝗧𝗶𝗀 Instruments. And it's a Russell 2000 stock. It's right at the 50-day moving average. The short-term RSI is right at 33. This thing is overdone, in my opinion. And if it's wrong, we get out right at the 50-day line. So that's 𝗧𝗶𝗀. Then CRTO, Nasdaq Composite, Advertising Agency, Tech, Communication. So I'm picking stocks that are not hardcore tech, but there's some technology with other factors, mixed. 200% also market cap, $2 million, small stock. Small stocks tend to move. When they move, 6.5 times on average more than S&P stocks over a 2-quarter period, the top stocks. I'll show you actually in a second. I'm not lying. I really mean that. And again, 50-day moving average and RSI is really grossly overbought, coming off of all-time highs or swing highs. And again, global technology company specializes in performance display advertising. 207% return. This company's doing something right. So I like the stock. I like the pullback. I like where it is. I like the industry. Next, InterDigital. Notice I'm picking tech, but they're not like Amazon tech. They're smaller stocks. Market cap, $2 million. Fundamental wireless technology, mobile devices, Russell 2000. Wireless, communication technology. Remember, communication technology, communication technology. That's where we want to focus right now. Technology, communication technology, and smaller stocks. So again, let's look at the chart on this sucker. Look at this pullback. Swing high or an all-time high possibly. Yeah, all-time high. I love pullbacks from all-time highs. RSI is moving down. Looks like a great stock. So I like this 𝗧𝗶𝗀. And again, 𝗧𝗶𝗀 is a Russell 2000, manufacturing, machinery, hard drives, a little technology, 73% return. 𝗧𝗶𝗀, I like CRTO. And again, all these are small $2 billion stocks. Global advertising agency, global economies picking up, communication, tech, 207% return. And this IDCC, all small cap stocks, all ready to go. InterDigital, Russell 2000, wireless technology, worldwide services, mobile services, networks, 2G, 3G, 4G. You see where I'm talking about? Growth, not a strict FANG stock, but a deviation, smaller, nimbler, 40% return, pulling back. I like these three stocks today. 𝗧𝗶𝗀, CRTO, IDCC. Now let me show you some magic. You're going to love this. So this is cumulative strength index. Now let me go to the S&P. This is the S&P 500. Strongest stocks over the last 6 months, 3 months, and 1 month. Look at the top performance. 40%, 40, 45, 45, 50, 51. And it's always like that. That's usually what it gets. Sometimes it'll go 70%. But look at the Russells. Let me show you the top stocks in the Russells. This is what I mean. Russell stocks tend to gain, if I could find my Russells here, they tend to gain 6.5 times. Look at this. Look at the numbers. 645, 384, 286, 244, 220. So what is this? 4 times, 5 times, 6 times. Yeah, the average. And remember, the Russell, look at the Russell the last few months. Hasn't done anything. So the Russell has been choppy. The S&P is sitting at new highs, right? Trending. Russell's been choppy. But meanwhile, top Russell stocks, 645%, 384%, 261, where S&P, typical 50. See that? This time maybe 5.5 times more, but on average, trust me, 6.5 times. So we got a lot of small cap Russell stocks, 𝗧𝗶𝗺𝗀, CRTO, IDCC on my radar right now. Folks, before I let you go, I've got something important. Recent volatility and inflationary speculation has some investors acting like gamblers with their retirement funds. You got to stop doing that. Chasing lost money, panic buying and selling, it's bad. It's all sad and it's bad for you. Casinos can be fun and they even comp you when you lose. But leave the gambling mentality at the door when you're trading. If traders can keep their heads on their shoulders and work a solid plan, history shows that these markets are exactly where they make good money. And I mean that. There's a strategy that trades stocks and ETFs that are linked, pairs. Now, one of these will do better than the other on a consistent and measurable basis. And this strategy works in all market conditions. It doesn't matter if the market's bullish, bearish, moving sideways. There's always a pair of stocks with one outperforming the other. Are you ready to find out how everyday traders like you can stop timing the market and focus on taking a more strategic approach to investing? Man, that sounds great. I love it. Taking a more strategic approach to investing, trading. I love this. You got to follow the link below and you got to check it out now. You got to learn about Jeff. This stuff is very, very cool. It's very effective. Most importantly, this is the same type of trading tactics that large institutional hedge funds use. You're going to learn to trade like a multi-billion-dollar hedge funds with this tactic. And it'll teach you how to leave the gambling mentality at the door. Follow the link below. Get in it now. Do it today. And make sure to like this video. Subscribe to this channel if you're watching on YouTube. Stay ahead of the markets by being the first to be notified when we post our next video. And have an amazing Tuesday. Bye, everyone.